Hi, and welcome to Ask the Mortgage Expert. It's time for us to face facts. The record low mortgage rates we've enjoyed a year ago, they're gone and they're not coming back. Home loans cost about a point more than they did as recently as last May, and they'll probably go up another point within the next year or by the end of 2014. We've started the year with the average rate for a 30-year fixed rate mortgage at 4.5%. That's the most they've cost in 15 months and up from a historic lows and from about 3.5% last spring. The reasoning behind all of this is simple. With the economy on the rebound, the Federal Reserve is starting to scale back its campaign of buying mortgage-backed securities. So they're driving down long-term interest rates, and every expert we've spoken to says they're nowhere to go but up over the next 12 months. Ryan Sweet, for example, he's a senior economist. He's with Moody's Analytics, and they advise banks on what to do and where the markets are going. And he said, and I quote, "We expect 2014 to end with a 30-year fixed rate mortgage at around 5.5%, or just a hair below or a hair above." There's no time to despair right now. Mortgage rates still remain well below historical highs, and the average this year is not bad whatsoever. So financing a house or condo will still be cheap. If you go back since 1970, the average cost of a 30-year fixed rate mortgage has been about 8.8%. Remember, those are all averaged costs, and savvy borrowers with decent credit can almost always pay a quarter to a half point less than that to finance a home. Spend a few minutes speaking with me about rates, and you can see what bucket you fall into. Now, as for the Fed, the person responsible for moving rates is the Fed. They've been buying $85 billion worth of debt a month since September 2012. A fairly even split between treasury bills and bonds backed by thousands of home loans. Now, by flooding the mortgage market with money, the nation's central banks pushed mortgage rates to record lows, as we know, in an attempt to boost real estate sales and property values. Last month, the Fed reduced those purchases to $75 billion, and further cuts are expected until the purchases end sometime in late 2014 or hopefully 2015. Lawrence Yun, who is the chief economist and vice president of research at NAR, which is the National Association of Realtors, also expects the average 30-year fixed rate loan to cost about 5.5% by the end of 2014. So while we're likely to see gloomy headlines about big spikes in mortgage rates, Yun says home buyers should keep things in perspective. Right now, people are used to seeing rates consistently at less than 5% for the past few years, but anything realistically under 6% is still historically rare. Yun says, and I agree with him, it's still a great rate. People will just need to make the proper adjustments mentally. We're paying more than 6% during the early 2000s, 7% or 8% during most of the 90s, and well over 10% during the 80s. So 1% rise in rates is going to make a difference. However, it shouldn't be a deal breaker for most buyers. Let's just say you're buying a home and the purchase is $250,000 and you're putting 20% down, which is the norm. With a 30-year fixed rate loan at 4.5%, you'd pay $1,013. That's principal and interest every month. At 5.5%, your monthly principal and interest payment will be $1,135. Now, while $122 a month isn't pocket change, that shouldn't alone price you out of buying a good home. Indeed, the Mortgage Bankers Association doesn't expect higher mortgage rates to put a damper on home sales. In fact, we expect home sales to increase by more than 10% this year, and that's counting new and existing properties. And the number of mortgages taken out to finance those purchases to be up more than 9%, closer to 10%. Refinancing your home is another matter. Millions of homeowners jumped at cheaper mortgages, and now when interest rates were falling, many refinanced twice, some replaced their loans 3 times. That boom is over. The Mortgage Bankers Association expects refinancing to fall by more than half this year. Here's the question. With so many homeowners already benefiting from the loan of a lifetime, who should, who would, who could be looking to refinance in 2014? The answer is simple. Borrowers who couldn't refinance over the past several years because they didn't have enough equity in their homes, their FICO credit score was low, but if rising property values have boosted your equity to the point where you can now refinance, rates are still low enough to make it worthwhile. If you can lower your rate by a percentage point or more, you should at least sit down and run the numbers. By far, I'm available to help you with that at any point in time. It's a free consultation. At this point, we've also seem to be having an easier time qualifying for home loans in this last quarter. Reasoning being FICO scores, which are credit scores, have gone up. People are more savvy now. They're reporting their income, let's just say, in a robust type of fashion with their accountants. And according to Ellie Mae, they feel that they will still see refinance transactions around 20 to 40% over the next coming year. So although conventional loans, unconventional loans, the average credit score was 734, that was down 32 points over the last year. The worst loans, or the lower credit score loans, have increased. Now you got to understand, purchases dropped from 716 in November 2012 to 686 this fall. So it takes less time right now to get things in order, get the file into processing, and get it approved. Right now, the average is down to 50 days from 65. If you work with me, it's more like 30. And that's the type of closing you want to do. You want to be closed on that transaction as quick as possible and before anything comes out in regards to work, in regards to credit score, which is very volatile, and so on. Give me a call, 718-869-4795, and I'll put a plan together that's right for you. Thank you.